Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about trade entries, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
So we're in the morning, we're analyzing our trade, we marked it all up. We don't need the profile anymore because that's just going to confuse us, but we can see very clearly where all the lines are. I'm going to auto fit so it gives me a little bit better scale. And we're trying to figure out what our entry possibilities are going to be. So I have all these lines drawn in. So I'm going to start drawing, first of all, my time frame that I'm looking to get into this trade. And that is between 9:30 and 11. Let's just expand it so that we can see exactly where we're at. Here we are before the market's open. We've plotted out our structure and our market. Now, I remember that when I originally had this, I also had a line here somewhere right around here, because I recognized that on the profile, there was something at that point that I liked, and it was this sort of bifurcation here. So I think there was a line there as well, right about here. We'll make that a yellow line, all right? And I know that there was a line here too. So I'll just draw that in. I'm trying to recreate where it was. I did a very quick analysis of where all this stuff was. All right, here we are in the morning and we have our time frame. And then what I usually do is I say, okay, these are the targets that I'm going after. I'm going after something in this range, right where it intersects these lines, right? Here, there, and there. Now, I may have had some up here too. I make these zones because my volume profile lines, sometimes they're perfect, but they could be off by a point or two. So that's why I say if it enters that zone. When price comes down to these lines, it's not always perfect. Sometimes it is. Good majority of the time it is, but sometimes it extends a little bit beyond or a little bit above. It doesn't make them any less valid. We're just trying to eyeball where we think the maximum effect of that line is going to be. So I draw these zones, and those are my target areas for entering the trade. So the next thing I do before the market opens, I'm thinking to myself, okay, what are the possibilities here? One possibility is that we come down to here and then we go up. Another possibility is that we go all the way down to here and go up. Could go all the way down to here and go up. Those are my first inclinations about what could possibly happen. And so as it turns out, this one in the middle seemed to be the most valid, because right on the market open it took off, and then it just zoomed right through this LVL here down to this middle one. I'll just highlight it by making its outline a little bit different than everything else, right? That's the one that I chose.
And Coach, the idea that you would think it might bounce off of there and then go up is based on the fact of a large drop down and then maybe the pullback that you talk about?
Okay, this is the theory, Jerry, that in any market that is trending, it is doing this, right?
Okay.
Where is the best place to enter in this market? If you can't pick this
when
point,
it pulls back.
Yeah, that's what we're doing. We're waiting for those pullbacks to a point where it's likely to bounce off of. Does that make sense, Jerry?
Yes.
So that's what we're doing. So had you taken that, and it would have popped up pretty sharply, I would suggest that if you had anywhere from a 10 to 20 wide trade, that you're probably going to be modestly with some profit, maybe anywhere from $20 to $100. Now, had it turned around on you and started going the other way, let's say it's $100, I would say that you want to get at least $50 out of that if it starts popping down. You might have missed it completely. All right, that's a tough one because it turned around very rapidly and it just went straight down. So chances are you might have gotten a small profit or a small defined loss. In a lot of cases, it would have done this and maybe meandered about and then stayed up here, but who knows? In this low volatility market, I've said this over and over again, you need to be taking quick profits because the gamma risk is high, and typically on a move like this, if you get $100 profit in such a short period of time on a very narrow fly, that's worthwhile of taking because it's likely not to remain there, and that is because the gamma risk is so high. And so these are good opportunities to take. And you might say, what if it goes down and then comes back up? If it went all the way back down and maybe bounced again, maybe you get into it again, right? But you got to take these quick profits. In high volatility, a move like this would have resulted in virtually no profit. I can tell you that. So those are one of the slight adjustments you have to make in low volatility. You have to be quicker on the draw because gamma risk is so high. So these abrupt moves into your trade represent an opportunity that you shouldn't throw away.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.